Well, welcome back to Finance Uncut. On today's episode, market crash warning and gold to $10,000. And coming in from Market Watch, how one rate hike by a small African nation could derail Powell's Fed inflation-fighting plans and sink stocks. But before we get to this article, let's just cut to a clip with Scott Minard.
If the bond market is saying we could go into a recession, do you think there is a chance of an economic recession in America in the next, 2 to 4 years?
Yes, I do. I think the bond market, based on how it's pricing, how forward rates are lining up, is telling us that the terminal rate when the Federal Reserve raises rates, that is how high short-term rates will get, the overnight rate, will be somewhere in the neighborhood of 1.75%, and that if we get to that level, that will be a level that would induce a recession. So if you think about it, we're not talking about rates even as high as they were the last time the Fed started to tighten. And, and if you look at this, Brian, it's really interesting. Everybody is so focused on negative real rates. That is, inflation's running, pick a number, 6%, I don't know, but it's somewhere in that area. And we have rates that are, for 10 years around 140. So the return, the real return on bonds, is minus 4% or more.
It's garbage. It's terrible.
Yeah, right. And so, but yet, if we raised or the Fed raised rates to be equal to the rate of inflation, and we had zero real rates, how would the markets react to a 6% overnight rate? Obviously, asset prices would crumble, economic growth would go into a tailspin. And so there's something going on here, something I have never seen in my career, and even in history I can't find, about the fact that real rates of interest are so low to maintain economic growth that there's something structurally different about this expansion. And the truth of the matter is that the market is telling us and sending us a message is, hey, Fed, if you want to get aggressive, then, start realizing what's going to happen to the economy in the next couple of years. And we're pricing for that.
So Scott is warning that a recession is just around the corner, which could impact asset prices. Now, what about gold? Well, do you guys remember what he had to say about gold and silver back in, around June, July this year? Well, once again, before we get to this article, let's just go back to the middle of the year and have a look at what he had to say about gold and silver then.
Is it possibly something called silver coin? You take something out of the ground, put it into a metal. Okay, I'm being a little sarcastic. I actually mean silver, the actual physical metal. It's been hot. You've been a long time bull of silver and a lesser extent gold. Do you remain bullish on the metals?
I am, Brian. I think, look, gold, as money leaves crypto and people are still looking for inflation hedges, gold and silver are going to be much better places to go. It's going to take a while to build a momentum in gold because the size of the market is so much bigger and there's so much gold in the world. But ultimately, I think gold will move into an exponential phase. I think $5,000 to $10,000 an ounce for gold ultimately is in the cards. And after gold starts to make a move, silver traditionally lags, and silver is the poor man's gold, and it's the one that will have the largest move on a percentage basis ultimately. So it's the high beta version of gold, and I think having a fairly significant allocation to that and the gold miners, GDX, would make a lot of sense right now.
Investors need to stop obsessing about the Fed taper and pay attention to the dozens of central banks that have raised rates so far this year. Now, this article is done by Callum Thomas. I follow Callum's work. Don't agree on everything with Callum, but I really do appreciate what he contributes to the whole financial and economic debate that we have today. The Federal Reserve is beginning the first phase of its very gentle, very conditional, and very cautious path to stimulus removal. Fed Chair Jerome Powell, just nominated for a second term at the helm of the US Central Bank, is intent on pushing back against any speculation about thinking about talking about rate hikes. But around the rest of the world, something quite different is going on in the halls of central monetary authorities from Latin America to Eastern Europe, Africa, and lately even some developed market countries. Back in January 2021, I tweeted half jokingly, half seriously, that a 300 basis point rate hike by the Bank of Mozambique was a sign of things to come. It was Mozambique's first interest rate hike in 4 years and came in response to what is described at the time as a substantial upward revision of its outlook for inflation. Fast forward 10 months, without really planning it, I decided to add to that tweet, making a live thread tracking the global policy pivot from rate cuts to rate hikes. Since then, I've noted rate increases, both large and small, by the central banks of Azerbaijan. Now, I should know that because the Baku Grand Prix is there and I'm a Formula One fan. And by the way, always have fantastic races there. So Azerbaijan, Zambia, Brazil, Russia, Iceland, Angola, Sri Lanka, South Korea, Norway, and New Zealand, just to name a few. In total, I've counted 94 interest rate hikes across 36 central banks so far this year. Now, obviously, if this was just one rate hike by one central bank or even a handful, might not even warrant a mention. But when you start talking about these kind of numbers, it's hard not to notice a pattern. In that respect, the chart below does a good job of mapping the pattern precisely. So this map, thanks to Refinitiv, it shows the proportion of central banks in rate hike mode defined as the last interest rate move being an increase. After dropping to zero early in 2020, fully 2/3 of emerging market central banks now have pivoted into rate hike mode. Why hike now? There are a few common themes as to why countries around the world are raising rates, including inflation, currency, and financial stability. Let's take a closer look. Inflation. We quickly went from few people talking about inflation at the start of the year to inflation being perhaps the most hot macro topic of the past few months. And myself being a contrarian, I was definitely on the inflation bandwagon very early on. But now I feel uncomfortable that almost everybody else is on the same bandwagon as me. I kind of almost want to get off it, but yeah. Anyway, base effects. Easier to record a higher pace of growth when comparing to a low base. Bounce backs, reopening plus stimulus equals strong demand, and backlogs, supply chain hell, combined to drive a sharp shift in both inflation and inflation expectations. Emerging economies are particularly sensitive to inflation. In recent times, as a group, they've tended to see an annual rate of inflation twice that which you would see in developed economies. Moreover, you only need to go back just over 20 years to see hyperinflation in emerging economies. As a group, they saw peak inflation of 115% in 1993 and double-digit inflation all the way through to 2000, which you can see right here in this chart, which is quite interesting, isn't it? Now, I've got a lot of friends who are from the old Yugoslavia area, the Croatia, Bosnia, Serbia area, and they're always telling me stories about what hyperinflation was like for them back then, which, as I keep saying in videos, I just can't get my head around what life would be like in a hyperinflationary environment. Think about your average emerging market central bank governor. Many of them were probably junior economists 20 years ago. Their formative years were no doubt heavily influenced by runaway inflation. Little wonder then they are hot on the trigger to hike rates as inflation heats up. Currency. Many central banks have also lifted rates in an effort to prop their currencies up as the US dollar strengthens. The line of reasoning here is twofold. Higher inflation, all else equal, means a fundamentally weaker currency, and higher interest rates appeal to carry traders looking to bank the higher yields, bringing flows and lifting demand for a country's currency. Financial stability. This term is basically a euphemism for Try not to blow up bubbles. Yeah, okay. In other words, if you keep rates too low for too long, you risk igniting asset price bubbles, which, if they burst in a chaotic fashion, can trigger financial instability. Warning bells. What do we got right now? Case in point, the housing bubble of the mid-2000s, its subsequent bursting, and the ensuing great financial crisis. On that note, we probably should pay more attention to this aspect, as developed economy housing market valuations have already sailed past the pre-financial crisis highs. Yes, that's right. Ultra-low borrowing costs have helped push housing market valuations in some countries well above pre-financial crisis levels. This is one reason why it's said that monetary policy is a blunt tool. It roughly does the job when it comes to avoiding deeper economic recessions and depressions, but the price is often higher asset prices. Market impact. The global policy pivot to rate hikes, likely to be soon joined by Canada and the UK, means investors can expect incrementally less of a tailwind for risk assets, upward pressure on borrowing costs, and likely more volatile markets going forward. And for Australia, with such high household debt levels, corporate debt levels, and now even government debt levels are now catching up to the rest of the world, we are very susceptible to higher borrowing costs. Indeed, mapping out the previous paths in policy, chart below shows how shifts from easing to tightening at best means a leveling out or regime shifts in the market. Example, from a near vertical line to more chopping and ranging. At worst, tight enough for long enough, this policy change can trigger an outright shift from bull market to bear market. And you can see this chart here with global monetary policy trends versus global equities. And so if this starts ticking upwards, then asset prices are in trouble. You might be thinking, what do all these random small emerging market central banks hiking rates have to do with the S&P 500? You've probably heard the saying that when the Fed sneezes, the rest of the world catches a cold. But in this sense, given the Fed is still likely to be dragging its feet on policy for some time, it's almost more that the rest of the world catches a cold and US equities sneeze. You only need to go back to 2015-16, where much of the volatility in US markets back then was driven or triggered by issues in China and emerging markets, or in the post-financial crisis period when the Eurozone debt crisis was raging and weighing on global investor sentiment. I remember this time very clearly because I was shorting Fortescue Metals and BHP. Fortescue Metals had some big debt issues back then too. They were really trying to pay off debt, and there were some actual whispers about, you know, their ability to continue. And I actually remember, I think it was February 2015 or 16. I sold some naked puts on BHP and just received huge premiums on that. And I was very happy at the time. I think BHP had fallen down into the $16 mark, and I was very much happy to start picking that up. Unfortunately, I didn't get exercise. The stock hit the bottom and moved up, and I didn't get exercise. But anyway. Beyond regional crisis, which can be precipitated by premature stimulus removal, the bigger issue is the common themes motivating monetary policy. While each central bank has its own set of circumstances, the common theme is a reaction to higher inflation, stronger growth, and a desire to avoid overcooking markets. It's the smaller developing country central banks that are most exposed to these global trends, and so we can look at them as bellwethers or leading indicators. The forces in motion that triggered a rate hike in Mozambique are the same forces that will ultimately drive the Fed to step away from stimulus. It may take time, but one thing I know to be true is that these things go in cycles. While it looks and feels like the Fed has your back forever in the markets right now, this won't be always true. Don't fight the Fed means swim with the tide, not against it, and the tides are clearly turning. So thanks to Charlie Bellello once again for doing this chart. Wonderful chart. Now you can see here we've got the US Fed funds, so the central bank rate 0.13, CPI 6.2. So we've got a negative real rate of 6.1. That's huge. That's huge. So I am surprised that gold has not performed better because of this. We got Australia here, cash rate 0.1, 3% CPI. Yeah, right. So negative 2.9 is the real rate. The UK, they've got a negative real rate of 4.1. And if we come back this way, Canada, negative 4.5. So these are the countries that I look at mostly. Also Japan and a few others as well. But you can see New Zealand, they've raked heights in October and November, 0.25 each time. So they've gone from 0.25 to now 0.75. Their CPI currently is higher than Australia's at the moment, but they still got a negative real rate of 4.2%. So anyway, it's going to be very interesting to see what happens. Yeah, it's going to be very, very interesting. Obviously, keep an eye on this. So what do you guys think? Do you guys think central banks are going to start raising rates? How much do you think they're going to raise? I mean, that's a debate. I think they will raise eventually soon. But the question is, how much? How far can they go? I definitely think that's going to put pressure on asset prices, but I still believe that CPI is we're not going negative CPI anytime soon. And so the negative real rates, we're still going to have negative real rates in my opinion, and that's why ultimately I'm bullish gold and silver. But anyway, that's my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, hit that like button. Really do appreciate it. Take care, guys. See you again on another episode of Finance Uncut.